Stop scrolling. They are lying to you about inflation. They are lying to you about the soft landing. And they are absolutely lying to you about the stability of the global economy. Right now, while the news distracts you with political theater, a financial nuclear bomb is ticking in the East. It is not in Wall Street. It is not in London. It is in Tokyo. What if I told you that the coffee you bought this morning, the interest rate on your credit card, and the very safety of your retirement fund are all tied to a decision made by a handful of bureaucrats in Japan who are currently trapped in a room with no exit? We are taught that markets move on supply and demand. That is the official narrative. But what if the entire global economy for the last 20 years has actually been an illusion built on free money stolen from the future, and the bill is coming due in 2025? This is not history. This is your wallet right now. If you feel like you are working harder but getting poorer, if you feel like the system is rigged against you, it is because of the mechanism I am about to expose. Before we descend into this rabbit hole, I need to know who is awake. Where are you watching from? Drop your flag in the comments right now. Let them see that we are a global community looking for the unfiltered truth. And if you are ready to see the receipt for the greatest financial heist in human history, hit that subscribe button. We are going to deconstruct the lie.
To understand the disaster of 2025, we have to look at the crime scene of 1989. Japan was the king of the world. The imperial palace grounds in Tokyo were valued higher than all the real estate in California combined. It was an era of excess, arrogance, and unlimited credit. People were buying golf club memberships for millions of dollars. Corporations were rolling over debt as if it did not exist. The belief was absolute. Prices only go up. Does that sound familiar? It should, because just like the American housing market in 2007 or the tech bubble of 2021, Japan's economy was not built on productivity. It was built on easy credit and a central bank that kept the money printer running hot to keep the party going. Then the music stopped. The Bank of Japan realized they had created a monster. They raised interest rates to cool the market. Pop! The stock market crashed 80%. Real estate values evaporated. They entered what economists call the lost decades. But here is where the history books fail you. They tell you Japan stagnated. They do not tell you how they survived. To stop the bleeding, Japan lowered their interest rates to zero. Practically 0% for decades, while the rest of the world paid 4%, 5%, or 6% to borrow money, money in Japan was free. This created a zombie economy. Companies that should have gone bankrupt were kept alive on life support. The government borrowed massive amounts of money to build bridges to nowhere, just to keep people employed. They printed yen to buy their own bonds, artificially suppressing yields to pretend they were not bankrupt. Sound familiar? Look at the United States today. Look at Europe. We have zombie companies in the S&P 500 that cannot pay the interest on their debt without borrowing more money. We have governments spending trillions on infrastructure bills while debt hits vertical trajectories. We have central banks intervening in bond markets to stop yields from exploding. Japan is not an anomaly. Japan is a time machine. They are 20 years ahead of the United States. They are the patient zero of the fiat currency experiment. But the modern parallel gets darker. In 2024, the United States is facing an inflation crisis, forcing rates higher. But Japan? Japan kept rates at zero. This created a gap, a massive, gaping canyon between the cost of money in the West and the cost of money in the East. The elites, the hedge funds, the megabanks saw this gap, and they did not see a warning sign. They saw a buffet. They realized they could exploit this divergence to print their own profits. Does it sound familiar? It is the same greed, the same hubris, but this time the leverage is not contained to one island nation. This time the leverage is woven into the algorithm of every stock market on Earth.
This brings us to the mechanism, the hidden engine. You might think the Japanese economy survived because of its strong manufacturing or disciplined workforce. That is the cover story. The reality is that Japan became the ATM of the world. Because the Bank of Japan kept rates at zero through yield curve control, giant financial institutions realized they could borrow yen for free. Literally, free money. They would take this borrowed yen, convert it to dollars, and buy U.S. Treasuries yielding 5%, or buy NVIDIA stock, or buy London real estate. This is the carry trade. It sounds technical, but it is actually a Ponzi scheme sanctioned by the state. The Bank of Japan prints yen to keep rates low. Hedge funds borrow that yen to pump up global asset bubbles. But there is a specific entity, a specific decision maker that turned this trade from a risky bet into a suicide pact. It was not just a rogue trader, it was the Bank of Japan itself, under the pressure of a name you need to know, Kazuo Ueda, the governor of the Bank of Japan. He was brought in to do the impossible, raise interest rates without blowing up the world. He is the man with his finger on the detonator. Here's the twist nobody saw coming. The market assumed Japan would never raise rates. They assumed the ATM would stay open forever. The entire global financial system, trillions of dollars in derivatives, pension funds, and insurance leverage, is betting on Japan staying at zero. But inflation in Japan hit 40-year highs. The people are starving because their currency, the yen, is collapsing against the dollar. Ueda had no choice. He had to raise rates. And when he did, just a tiny fraction, the trap snapped shut. The receipt for this free money is wilder than you think. It is not just that the trade becomes expensive. It is that the entire shadow banking system has used this trade as collateral for a $1 quadrillion derivatives market. If Japan normalizes, the collateral vanishes. And when the collateral vanishes, you do not get a correction, you get a margin call on the entire world. You will not believe the name of the entities most exposed to this crash. It is not just Japanese banks. It is the very institutions managing your 401k.
We need to dissect this mathematically because the numbers are the only thing that does not lie. Let's simplify the yen carry trade mechanism so you can explain it to your family when the news tries to gaslight you next year. Imagine you can borrow $100 million from a bank in Tokyo at 0.1% interest. That costs you almost nothing. You take that $100 million, convert it to US dollars, and buy US government bonds paying 5.5%. You are making the spread, the difference of 5.4% for doing absolutely nothing. That is $5.4 million a year in free profit. Now, imagine you are a greedy Wall Street algorithm. You do not just do this once. You use leverage. You leverage that trade 10 to 1. Now, you control $1 billion worth of assets using borrowed Japanese money. This has been the status quo for years. This flood of Japanese liquidity is what pumped up the U.S. S&P 500. It is what kept U.S. mortgage rates from hitting 10%. Japan has been the silent whale effectively funding the U.S. debt addiction. Here are the 5 shocking statistics you need to engrave in your mind. Number 1, $20 trillion. That is the estimated size of the global carry trade exposure. To put that in perspective, the entire 2008 subprime mortgage crisis was triggered by roughly $1.3 trillion in bad loans. We are looking at a bubble almost 20 times larger. Number 2, 250% debt to GDP. Japan's national debt is the highest in the developed world. They owe 2.5 times more than their entire economy produces in a year. If interest rates rise to just 1%, the interest payments alone would consume nearly 20% of the Japanese government's entire budget. It is a mathematical death spiral. Number 3, $1.2 quadrillion. This is the notional value of the global derivatives market, the shadow banking. A huge portion of these complex bets, specifically interest rate swaps, relies on stable currency exchange rates. If the yen spikes in value because everyone rushes to pay back their loans at once, these derivatives explode. Number 4, August 5th, 2024. Remember this date, the Black Monday of 2024. The Bank of Japan raised rates by a measly 0.25%, just 0.25%. What happened? The Japanese stock market fell 12% in one day, the worst drop since 1987. The U.S. market lost trillions in hours. That was a warning shot. That was the system trembling at a 0.25% hike. Imagine what happens at 1% or 2%. Number 5, 50% of the bond market. The Bank of Japan currently owns over 50% of all Japanese government bonds. There is no real market anymore. It is a Soviet-style command economy disguised as capitalism. If the BOJ stops buying, there are no other buyers. The price crashes, yields spike, game over. This is parasitic finance at its worst. The illusion of wealth in the U.S. stock market was largely funded by this borrowed time. When Japan raises rates, that money has to go home. Hedge funds have to sell their Nvidia, sell their Bitcoin, sell their gold to buy back the yen to pay off their loans. This triggers a massive sell-off across all asset classes simultaneously. And here is the engineered collapse aspect, the conspiracy reality. The central bankers know this. Jerome Powell knows this. Kazuo Ueda knows this. They are not stupid. They are trapped by moral hazard. They printed money to save the banks in 2008. They printed money to save the system in 2020. Now the debt is so high that they cannot fight inflation without crashing the debt, and they cannot save the debt without causing hyperinflation. So what is the plan? The plan is a controlled liquidation. They will allow the Japanese bond market to crash. This will cause yields to spike globally. It will wipe out the value of existing bonds, which are mostly held by your pension funds and your insurance companies. It transfers the loss from the elites, who are smart enough to short the market or move into hard assets, to the public, who are holding the bag of paper promises. They are effectively using the Japanese bond crash as the scapegoat. When the markets collapse in 2025, they will not blame their reckless money printing. They will blame external factors in Asia. They will blame speculators. They are burning the bridge while they are still standing on it, hoping they can jump to the helicopter of Central Bank Digital Currencies, or CBDCs, before the structure hits the water.
This bond crash is the requisite crisis needed to usher in the new system.
The modern financial system is not a fortress. It is a house of cards built on a fault line, and the ground in Tokyo is shaking. In 2008, the collapse took months to unfold. In 2025, with algorithmic high-frequency trading and interconnected global derivatives, the collapse will not take months. It will take milliseconds. The speed of the unwind will be unlike anything we have ever seen. When the yen carry trade truly unwinds, liquidity evaporates. The ATMs stop working. The credit lines freeze. The buy-the-dip mentality will be replaced by sell everything at any price. The danger is not just financial loss. The danger is denial. We trust these institutions because they are built on marble and glass. We trust them because they have stood for decades. But remember, the Roman Empire looked eternal the day before the barbarians breached the gates. These institutions are built on borrowed time and borrowed yen. If you are holding all your wealth in paper assets, in bonds that yield less than inflation, or in stocks inflated by foreign leverage, you are standing in the blast zone. We have deciphered the code. The first domino is not tipping. It is already falling. The shock waves take time to travel across the ocean, but they are coming. Do not let them catch you sleeping. Do not let them tell you nobody saw this coming. We saw it. We broke it down. I have to ask you one final question, and I want you to answer it honestly in the comments. Are we wiser now, or are we just walking the same path as 1989 and 2008, just wearing better suits? If you want to survive the transition from the old economy to the new reality, you know what to do. Subscribe, turn on notifications, share this video with someone you care about, because skepticism is the only shield we have left. I will see you on the other side of the crash. The domino has fallen.